year chart of the NASDAQ 100 going to a huge peak, then down, and then back up to that peak. What is this telling us? Maybe something similar, which is real interest rates are negative, which means below the rate of inflation. It reduces the penalty for owning a non-yielding asset like gold, and also it contributes to that scarcity of free cash flow and earnings yield out there that is benefiting tech stocks. I do think, just one quick note on gold, if people want to create a storyline about what gold is telling us about the dollar or the sustainability of the government debt or anything like that, you have to ask yourself, what was gold telling us here in 2011 that really was worth listening to in that respect for the rest of the decade? My point being, it's not necessarily prescient about what's going on systemically necessarily. It's just working right now. And by the way, massive inflows into the gold ETFs too. People have caught on, Andrew.
It could be either, Mike. It could be, you know, with so much liquidity, it can be money just going everywhere.
Yeah, it's another way to frame it, right.
Risk on, or it could be they're not making that much more of it, and we're sure making a lot of currencies all around the world. So, you know, it could be either. I mean, the longtime gold bulls say, well, this makes perfect sense.
Right.
And it should be 3 times higher than it already is.
Sure.
But other people, is it non-correlated with financial assets more than it was?
I mean, the correlation kind of flips back and forth. Off the 2009 market bottom, you know, it rallied right along with equities. So it's not always non-correlated.
It can be a risk on, it can be a money going in looking for a home, whether it's Microsoft or gold. Anyway, thank you. How is it out there, Mike, in the NASDAQ 5000 building? It's good?
Pretty quiet, but perfectly comfortable.
We could have 2 of them now, since we're above 10,000.
Yeah, that's right.
We'll build another one next door.
Yeah.
All right. See you later. Andrew.
Well, Mike, stay with us. Don't go anywhere, because we want Mike to be part of this conversation as well. We're going to continue to talk about the markets and, in particular, with earnings. Our next guest saying that earnings are going to be pushing equities a bit higher, but urging caution after that. Joining us right now is Barre Knapp, Managing Director at Ironside Macroeconomics, along with Mike Santoli, who, Mike, come on back. We'll get him in the window as part of this conversation. Barry, you're thinking a pause is coming? This is the first time I've sensed that any kind of caution.
Yeah, no, we've been unabashedly bullish from the lows, but I think as we get into the August through October time period, you know, there's a couple of things to consider that will probably cause a decent stall out. You've got the obvious seasonality. The way I tend to look at positioning and market sentiment is really based on the vol markets, right? So it's not just the level of the VIX, but it's the VIX futures curve, how the front month looks versus the 6 month, and then the premium for out of the money puts. All those things have come down enough so that sentiment is much more balanced. And then we've got the obvious election considerations. And I know you guys are asking this question all the time. Okay, well, you know, it looks right now like a blue wave is probable, which undoubtedly means higher taxes on capital gains and income and the like. Why hasn't the market reacted to it? And typically it doesn't until you get to around about August through that period. So I think that will come into play as well. And all those factors would warrant a stalling out for a period of time. We've had a tremendous move higher, but pushing all the way back through the highs, to me, seems unlikely with those considerations through that time period. So look, it's still early in the business cycle. We've been saying that all along. March 23rd was the start of a new business cycle from an investor perspective. So I wouldn't, make the switch from cyclical names to defensive names, but I would raise some cash levels here and look for a bit of weakness to redeploy that cash for a year-end rally is how I would tactically think about the next few months.
Mike, how much do you think the Barre view of the world is starting to seep in as a conventional wisdom to the market? How much of it is an outlier?
Well, I think, first of all, I think Barry is very right. I would defer to him on this idea that a lot of people for most of the last few months, have been fighting this rally. They've not been comfortable with what seemed to be driving it. And that has somewhat changed in terms of people's positioning, people's expectations for what this is. A couple of months ago, if you said this is a new bull market, most people would have disagreed with you. And that seems to have changed. So I don't think it's necessarily that everybody is ragingly bullish, but I do think it is much more of a mix between people who think that this is the start of something big on the upside and those who are still fighting it. So that makes sense to me. They're probably in this coming quarterly earnings reporting season, it seems like the bar is very, very low. Basically, analysts have kind of just, written down their forecast to whatever seems the lowest plausible number. And so you're going to see companies beat. The question is whether that's already somewhat priced in. So it does make sense. Now, with regard to the election influences, I completely agree that it sort of starts to take the market captive, at least psychologically, somewhat before the elections. A lot of time that just means it kind of holds still. It even did that in 2016. That's not the same thing as saying the market knows what it wants and needs out of the election result and what the policy implications are going to be and all the way down the line. But in the run up to an election, it does make sense that it basically just sort of stops and waits.
Hey, Barry, when you think about, you think there's going to be a real push, you're saying, towards the end of the year. For those who are not going to necessarily play this market, quote unquote, day by day, is there an argument to just hold steady and try to ride out whatever you think the next couple of months of choppiness may or may not be?
Sure, and that's what I'm trying to say when I make the argument that this is early in the business cycle when the returns are strongest. So, to reduce your risk wholesale because you're concerned about the election, to me, doesn't make a heck of a lot of sense. What's more important then is to get those broader themes right. So you guys keep talking about technology and the cloud companies, and there is no doubt that that is an incredibly strong secular trend. But what'll be really interesting through this business cycle is the integration of that into different sectors. Healthcare, for example, the lowest margins of any major sector. They have the highest revenue contribution, but a fairly low earnings contribution to overall S&P earnings. But things like telemedicine are just going to accelerate through this business cycle. So a secular trade like that or theme like that, you can buy and just hold.
Barry, one question, though, about the sort of idea that we're going to have this is a new business cycle. What does unemployment look like in this business cycle, in your mind? Longer term out. I think by the end of this year, people are thinking we'll be, maybe 10% high, 8s or 9s. But are you thinking it comes back to where we were before, or do you think that you're able to have an accelerating business cycle even with unemployment at high levels?
No, first of all, my number for the end of the year would be close to Jim Bullard's, right? He was on Wilf and Sarah show yesterday afternoon and called it 7. So I've been on the more optimistic side for labor market turnover. So I'd be more like that. But listen, what this COVID did was really accelerate creative destruction. And that process is going to leave a whole bunch of industries behind. And so there is going to be this residual surely into 2021 that could linger into 2022, that it will take some time for that to come down. That's not to say that that growth gap won't close, but there's going to be an employment gap for sure. So, but marking the stock market around the unemployment rate is a little bit. It's not really the right way to go at it, because you could just get incredibly powerful earnings from tech, and then the market's at new highs and everyone's scratching their head because the unemployment rate's still 6. But that to me is a more probable outcome.
Okay. Barry, I want to thank you. Michael, thank you. Nice to see everybody.
All right. Good morning.
Peck?